The new S-Class, the new luxury, brought to you by Mercedes-Benz.
The Securities Commission says it will be in touch with Malaysian Anti-Corruption Commission Chief Commissioner Tan Sri Azam Baki and parties involved following Azam's claim that his share trading account was used by his brother to purchase shares in 2015. Azam reportedly told this to the Anti-Corruption Advisory Board, or LPPR, which is one of 5 independent monitoring bodies of the MACC, following allegations that Azam has interests and shareholding in several companies. In a press conference on January 5th, LPPR Chairman Tan Sri Azam Baki said the board was satisfied with Azam's explanation that the purchase of shares was made via the open market with no conflict of interest or criminal conduct involving Azam, and that the shares were transferred to Azam's brother Nasir Baki the same year. In a statement, the SC said that it would contact the parties involved to verify the statements made as well as gather any relevant evidence. The regulator notes that under Section 25 of the Securities Industry Central Depositories Act 1991, every securities account opened with a central depository must be in the name of the beneficial owner of the deposited securities or in the name of an authorized nominee. In addition, Section 29A of SICDA stipulates that all dealings in securities shall be effected only by the beneficial owner of the securities or an authorized nominee. The SC also clarified separately to The Edge that conflict of interest claims are not under its purview. According to news reports, Azam also held a press conference on Wednesday to explain that the shares were bought by his brother using his own funds and described the allegations against him, which had gone viral on social media, as malicious and a total lie to create a negative perception against him. The Malaysian Institute of Economic Research says it does not support the proposal for the employees' Provident Fund members to further withdraw money from their EPF accounts to mitigate the financial impact from the COVID-19 pandemic, as the pension fund is not designed to deal with calamities and pandemics. In a statement, MIER said the EPF is instead intended to ensure that its contributors enjoy a decent life after retirement. The Institute says that sound economic reasoning should guide EPF withdrawals, not populist policies. The government-initiated withdrawal schemes, namely i-Lestari, i-Sinar and i-Citra, that amounted to 101 billion ringgit, have resulted in a severe depletion of retirement funds for most of EPF's members, although it managed to provide some financial relief. MIER said the mass withdrawals have resulted in 6.1 million EPF members now having less than 10,000 in their EPF accounts, with 3.6 million members now having less than 1,000 in their retirement fund. MIER said the government must consider broader social protection and social safety net strategies because there should be contingency plans and schemes that can kick in the face of calamities and other crises. The Institute adds the burden of these events is usually felt worst by those who are least prepared to face them, and that governmental support is needed to rebuild their lives. MIER warns that Malaysia is expected to become an aged nation by 2030, and further EPF money withdrawals will put additional pressure on the future cost of healthcare, income security and a post-retirement income scheme. Padini Holdings' share price rose over 3% to its highest level in about 2 months today after the Employees' Provident Fund raised its stake in the clothing retailer. The counter opened at RM2.91 and peaked at RM3.03, but was unable to hold on to its gains. It ended the day 9 cent or 3.09% higher at RM3, with 495,500 shares traded. Prior to Thursday, Padini last touched RM3.03 on November 20th last year. On Wednesday, the EPF upped its stake in Padini to 5.76% or 37.91 million shares after acquiring 37,500 shares in the company. Padini slipped into the red with a net loss of 16.86 million for the first quarter of FY22, compared with a net profit of 20.8 million a year earlier, as a majority of its outlets were closed during FMCO. Quarterly revenue dropped sharply to 81.4 million from 310.7 million ringgit. Reach Energy has announced that its unit in the Republic of Kazakhstan might be affected by the country's recent state of emergency declaration. In a filing to Bursa Malaysia today, Reach Energy said the government of Kazakhstan had on January 5th declared a 2-week state of emergency in Almaty and the western Mangistau province, where MIER-Oil, the company's subsidiary, is located. Reach Energy further announced that the state of emergency includes curfew, movement restrictions, ban on mass gatherings, and internet disruptions. The company said the cumulative effects might contribute to a shortfall and impact the company financially and operationally. As such, it is unable to ascertain the full financial and operational impacts at this juncture due to the uncertain situation in Kazakhstan. According to its website, Reach Energy took over the operatorship of MIER-Oil with a majority of 60% indirect interest as of late 2016. MIER-Oil holds the entire subsoil use rights in an 850.3 square kilometre onshore hydrocarbon exploration and production contracted area in the Mangistau province. According to a Reuters report, Kazakh President Kassym-Jomart said on Wednesday that he had appealed to a Russian-led security bloc to help Kazakhstan deal with a terrorist threat. This comes as the Central Asian Republic saw the worst unrest in over 10 years, which was initially sparked by a fuel price rise. DBS Group Research expects Malaysia's economic recovery momentum in 2022 to be among the strongest within the Asian region. According to DBS Group's rate strategists Duncan Tan and Eugene Low, the country's growth prospects are stronger, while its fiscal consolidation process is expected to be slower and more protracted than that of its peers. According to them, a slower fiscal consolidation process means that government financing needs are likely to stay elevated for longer. Tan and Liao note that monetary policy is expected to stay accommodative in the near term, and a pivot to a less dovish stance may only occur closer to the second half of the year. Therefore, DBS Group is expecting Bank Negara to only hike rates in the third quarter of 2022, followed by 2 more hikes by first quarter of 2023 and a pause thereafter for the rest of 2023. They explain that high vaccination rates and transition to endemic living should mean relatively low risks of retightening restrictions, and by extension, limited downside risks to growth outlook should more variance surface.
This program was brought to you by Mercedes-Benz.